What is accounting cycle or process? Write about the various steps involved in it. Describe the accounting cycle. Or it can be a different type of a question asking the same topic, which is what is accounting cycle? The process which starts with the initial business transaction and ends up with preparing of final accounts. This is known as accounting cycle or process. This process involves a sequence of activities which are repeated in every accounting period. So this is also known as accounting cycle. Now, before going further, let us first understand what is accounting. Accounting is the process of recording, organizing, summarizing, and reporting a business's financial transactions from the moment a transaction happens to preparing final accounts like profit and loss account and balance sheet. In simple terms, accounting is the process of keeping track of a business's money, how it comes in and how much goes out, and where it all goes. It helps people to understand if the business is making a profit, how much it owns, and how much it owes, and how it's doing financially. All this information might be important to the company, but other than company, it also has an impact on the government because the tax has to be applied and also the investors. Now, moving on and understanding the accounting cycle. As you can see, there are various steps. Now, accounting cycle starts or begins with transactions. Transactions, I mean identifying business transactions. Then moving on with journalizing transactions. Then posting those transactions into ledgers. And then preparing trial balance. Now, why this step is important? Let us take an example to understand. Let's say there is a person or an entrepreneur who has started his business 6 months to 1 year ago. Now he has some profit in his hand. Now, if he is spending this profit for expanding his business or for buying some raw materials for his business, then these are considered to be business transactions. If he is buying something for himself, maybe a car or bike or some jewelry, then all of this will be his personal expense. When we combine personal expenses and business transactions, there would be no tally of business accounts. So it is important to differentiate and identify only business transactions and record them. Because business transactions we are doing for the business and not for the owner. Next, moving on to the second step. Journalizing transactions. In the second step of accounting process or cycle, the identified business transactions are recorded and classified in journal in the form of journal entries. Such a process of recording transactions in journal is known as journalizing. Usually, journal is also known as book of primary entry or original entry. It is because every business transaction is first recorded in these books on daily basis. Like if any transaction had happened, first you enter in journal. For example, as you can see here, Sneha account debit to sales account. Now, there had been a transaction where customer Sneha had purchased some goods on debit, which means she had taken the goods, but she said she would be paying after some time or next day or something. So she still have to pay. So we had mentioned their name and it is debited because as personal rule says, debit the receiver and credit the giver. So Sneha had been debited and credit may we have mentioned sales because sales is the revenue account. Revenue increases are recorded as credit, which is again credit all incomes and gains. Additional to this, journal is further classified into various accounts which are called as subsidiary books. For example, sales transactions are recorded in sales books, purchase transactions are recorded in purchase books, and so on. It is because in growing of a business or in large businesses, Instead of mentioning everything under one journal, they maintain different subsidiary books to make it more organized and easy to identify such transactions. Next, moving on to the third step. Next, posting transactions in ledgers. In the third step of accounting process or cycle, transactions recorded in journal are now posted to ledger accounts. These accounts are also called as secondary books because transactions are recorded for the second time. This book can also be defined as the accounting book where journalized transactions are being classified in separate accounts. It considers set of accounts and includes all type of business accounts. For example, personal account, real account and nominal account. In simple words, it means transfer of journal entries into individual ledger accounts to classify transactions by account. And the purpose of this is to help track businesses for each account. Now, this will make journal entries more classified and simplified so that it is easy to check how much is the debitors, like how much we have to receive from them, and from which debitor we have to receive how much amount. And if it is sales account, then you will know how much sales you made for a month or for the year or for quarter, like 4 months or 6 months. So this is to simplify the journal entries and note together what is the status of each account. Next, we have step 4, preparing trial balance. In the fourth step of accounting process, trial balance is prepared. After journalizing and posting transactions in ledger, trial balance is the statement which takes into account all the debit, and credit balances from the ledger accounts. It is prepared in order to verify the balances of debit and credit are matching or not. If both sides of trial balance, that is, debit side and credit side, is tallied, then it means that the books of accounts are accurate. In other words, it is the simplified form of ledger. Here, we list all the ledger accounts with their debit or credit balances to ensure total debit equal to total credits. Now, this is done to check for the arithmetic accuracy, and it will help to prepare better and perfect financial statements. Step 5, manufacturing, trading and P&L account, which is profit and loss account. Here, manufacturing account calculates the cost of goods manufactured. Trading account calculates the gross profit or loss by comparing sales with the cost of goods sold. Profit and loss account. This shows net profit or loss by including all operating incomes and expenses. Next step we have preparing balance sheet, which is step 6 and the final step. Here the final financial statements that shows the company's assets, liabilities and equity at a specific date will be presented here. In this step of accounting process, balance sheet is prepared by considering all the details from the above 5 steps. It is called as financial statement of an organization, which shows the actual financial position of the organization's business on a particular date. It is a kind of a statement under which organizations' assets, liabilities and capital are separated to know the liquidity position. Now, liquidity position means the company's ability to face if something goes wrong and the business has to shut down. In that position, how well a company can balance its financial worth. Now, balance sheet, it is static in nature and it is often referred as statement of equity because both sides assets and liabilities are tallied. Thus, the accounting process or cycle would be prepared in the same manner by a business organization for every financial year. If organizations want to run their business smoothly, then they should process all the steps in a sequence order.